Now, I have to start by saying that there are probably no guaranteed, surefire ways to set yourself up financially for the future. But even so, if your goal is to become more financially stable, I do feel that these money moves, coupled with budgeting and smart spending, can point you in the right direction and provide the boost you need to achieve your financial goals, whether it's to achieve financial freedom or maybe financial independence. So the first thing that can help is to start utilizing an investment calculator if you haven't already. So most people know that investing at a young age can shape our financial future. It gives us a head start where we're able to harness the power of compounding over a longer period. So even if you can only invest a small amount, there's still the possibility of a nice return because your money has more time to grow. But while investing at a young age is a smart money move and it's a great way to get your financial life off to a good start, it is equally important to periodically use an investment calculator to monitor your progress and also estimate your potential return. And this is something that a lot of people don't think to do. So even though they might be really good with making regular contributions into their retirement account or other investment accounts, in a way, it's as if they're essentially still winging it because they've never ran the numbers to see what their ending balance could look like with those contributions. Let's say you've been putting $150 into an investment account every month for the past 20 years, and you currently have $88,000. And let's also say your goal is to retire at age 65 with $1 million. If you're 45 years old, meaning that you only have 20 years left to hit your goal, an investment calculator can help you gauge whether the amount you're currently contributing is enough. And if it isn't enough, you can also use the calculator to determine how much you would need to increase your contributions in order to hit the 1 million mark. Now, in this scenario, if you never increased your retirement contributions and you continue to only put $150 a month into your investment account, assuming an 8% return, after another 20 years, you would only have about $520,000, which is only half your target goal. But if you plug everything into an investment calculator, you'd realize that to retire in 20 years with your goal of $1 million, you would need to step it up and invest $1,000 a month. And if that's not doable, you would have to explore other options, such as increasing your contributions to $600 a month and retiring at age 68 instead, or contributing $375 a month and delaying retirement until age 70. So the bottom line is that if you want to ensure that you're putting away enough money for the future, a calculator is your best friend because you can easily analyze different scenarios and then adjust your contributions accordingly. And while we're on the subject of planning for the future, you can also avoid having to make significant increases by making a concerted effort to gradually increase your retirement contributions. And this is especially important if your employer matches your 401k contributions. Some people get a job, choose the amount to contribute, whether it's 3% or 4%, and yet they never increase their contributions, even if they can afford to, and even if they've received several raises over the years. However, if your job offers a 401k match up to a certain percentage, and you're not taking full advantage of this program, even though you can afford to, you are leaving a lot of money on the table. If your employer offers a 100% match up to 3%, yet you're only contributing 2%, that 1% that you're not getting might seem minor. And this is also where an investment calculator comes into play, because if you plug in all the numbers and run both scenarios, you might find that after 30 years, that 1% can be a difference of $150,000. So my recommendation, whether you have an IRA, a 401k, or any investment for that matter, is to gradually increase your contributions. So you can start with an amount that you're comfortable with, and the next year, step it up by at least 1% and continue this for as long as you can. Also, making an extra mortgage payment at least once a year can have a huge impact, and it can accelerate owning your home outright. Whether you're trying to retire early or you simply don't want to bring a mortgage payment into retirement, extra principal-only payments are powerful with chipping away at the balance faster. Now, some people will choose a 15 or a 20-year mortgage when they want to pay off their home early. And if that's your goal, you can definitely select one of those options. But another thing you might consider, which can help you get about the same results, is to choose a 30-year mortgage. That way you're not locked into a higher payment every single month. and then make 2 additional principal-only payments every year. Now, everyone's situation is different, so the time frame that you're able to pay off a mortgage with extra payments will depend on numerous factors, such as how much you owe and your interest rate. I plugged a few numbers into a mortgage calculator and ran a few scenarios, and I found that by making 2 extra principal-only payments a year, that could reduce a mortgage term by as much as 9 to 12 years. So not quite 15 and 20, but pretty close. And there are different ways to approach these extra payments. Some people might prefer to make one lump sum payment, maybe after they receive a tax refund or a work bonus. Or you can add a little more to each monthly payment and then apply the extra money to principal. So let's say your mortgage payment is $2,000 a month and you want to make one extra payment every year. What you would do is take that $2,000, divide it by 12, and then make an extra $166 principal payment each month. And the benefits of paying off a home loan early are probably obvious. For one, you're able to save a substantial amount on interest over the life of the loan. And secondly, it can shorten your mortgage term. And when you don't have such a big house payment hanging over your head, that can open up opportunities. You can also set yourself up financially by not overspending on a house or car. And I don't have any numbers to back this up, but I'm willing to bet that this is where a lot of people go wrong. Now, these are big expenses, so you can expect to spend a good chunk of your money. But even with a higher price tag, you want to be so careful that things do not cross into the overspending side, because that's when problems really start to develop. And signs that you may have overspent on a house or car can include struggling to make monthly payments, constantly relying on credit to cover expenses, feeling stretched financially, and even not being able to meet related costs. And to give you an example of related costs, I live in a state where we have personal properties / car taxes every year, and the amount that you owe is based on the value of your car. So if you purchase a luxury or a more expensive car, you're going to pay a higher tax. And over the years, I've heard of different stories of people who would buy a luxury car, and even though they're able to make the monthly payment, when car tax season comes around, they can't afford the extra payment. And going even further, sometimes they have difficulty even affording the higher maintenance that comes with the car. So the point is, if you're thinking long-term financial stability, you have to think past the present and make sure that your housing and transportation costs remain within reasonable limits, meaning that you're able to cover these while still funding your savings, funding your investments, and taking care of other financial priorities. And as a general rule of thumb, it's recommended to spend no more than 28% to 36% of your gross monthly income on housing and no more than 10% to 15% on car-related expenses. And I realize that housing costs have increased. So depending on where you live, it might be very difficult, if not impossible, to keep your numbers within those percentages. But at the same time, that's not the situation for everyone. So for some people, there might be plenty of room for adjustment. So from time to time, do a reassessment and make sure that your housing and transportation expenses are reasonable to your income. In addition, diversifying your income can also help you achieve financial stability. Relying solely on a single source of income can leave us vulnerable to unexpected changes, which can include job loss or industry downturns. But on the other hand, creating multiple streams of income can help mitigate risk, increase your earning potential, and unlock new opportunities. And just so that we're clear, creating multiple income streams does not necessarily mean taking on multiple jobs and sacrificing all of your free time. That's a concern that a lot of people have, which is understandable because we only have so much time or energy in a day. So when it comes to diversifying, seriously look into creating passive income streams from things like rental properties, dividend-paying investments, or digital products or courses that generate revenue while requiring minimum ongoing effort. And I always recommend multiple income streams, even if you don't need the money, because anything can happen with your day job. And if you were to lose that income, this can keep your head above water and keep you afloat until something else comes along. Plus, there is the potential for your side hustle to take off and make more money than you ever thought was possible. You might go into it thinking that you only want to make an extra $500 or $1,000 a month. But if you're doing something that fulfills a need and it takes off, The income that you earn from your side hustle could potentially replace the income that you receive from your traditional 9-to-5 job. So that's all that I have for you guys today. Don't forget to like, comment, and share, and also subscribe if you like personal finance and you want to see more videos like this. I typically post every weekend, so thank you again for watching, and I'll see you in a few days.